If you use a credit card, or you're thinking about getting one, you need to hear this. Because most people think credit card companies make money when you swipe the card. That's not the real game. Here's the problem. Most people were taught one of two bad lessons about credit cards. Lesson number one is, credit cards are dangerous, so avoid them completely. Lesson number two is, credit cards are amazing. Just get points, build credit, and you'll be fine. The first thing you need to understand is this. Credit card companies do not need you to be reckless. They just need you to be slightly careless for a long period of time. That is the game. People imagine the ideal customer for a credit card company is somebody going on shopping sprees and blowing up their finances overnight. That person exists, but that's not the only profitable customer. Sometimes the most profitable customer is the normal person with a job, a decent income, a few subscriptions, groceries on autopay, and a balance that just kind of hangs around month after month. This is where it gets expensive. Let's say somebody puts $3,000 on a card. Not because they're irresponsible, just because life happened. Car repair, plane ticket, a few bigger than normal months. Then they tell themselves, I'll pay it down soon. But instead of paying it off aggressively, they start making the minimum. That sounds small, until you do the math. Minimum payments are not designed to get you out fast. They are designed to keep the account current while interest keeps doing its thing in the background. So the balance goes down slowly, the interest keeps stacking, and what felt temporary turns into a long, expensive leak. And this is where people get trapped psychologically. Because if the minimum says $75, your brain says, okay, I handled it. No. You maintained the debt. You did not solve the debt. That distinction is everything. The minimum payment is not a progress plan. It is a survival number. If all you ever do is pay the minimum, you can stay in debt way longer than you expected and pay dramatically more than the original purchase was ever worth. Official consumer guidance has long warned that making only the minimum can stretch payoff time into years and increase total interest paid substantially. Consumer Financial Protection Bureau. So the first thing they don't want you to notice is that the monthly minimum is not helping you nearly as much as it feels like it is. Now the second thing you need to understand is even more important. Rewards are not valuable if they cause you to spend more, carry debt, or ignore the real cost of borrowing. This is one of the biggest sleights of hand in personal finance. A card says 2% cashback. Another says 3x points on travel. Another gives you a sign-up bonus if you spend a certain amount in the first few months. And people get excited because it feels like they're beating the system. But most people are not beating the system. They are being nudged by the system. Here's how it works. If a card gives you 2% back, that sounds great. And if you pay your balance in full every single month, it can be great. But if that same card has an interest rate north of 20% and you carry a balance, your little rewards win gets destroyed fast. Let's keep the math stupid simple. You spend $2,000 and earn 2% cash back. Great, that's $40. Sounds good. But if you carry that balance and start paying heavy interest, that $40 reward can get wiped out quickly. So now what looked like a smart consumer move was actually an expensive borrowing decision wearing a rewards costume. That's the part nobody wants to say out loud. A lot of people are chasing points while paying interest. That is like stepping over a dollar to pick up a dime. And it gets worse. Rewards programs can change. Redemption values can change. Conditions can be buried. Points can expire, get devalued, or become harder to use the way you originally expected. Consumer regulators have specifically warned about bait-and-switch style rewards marketing in fine print that conflicts with the way rewards are advertised. Consumer Financial Protection Bureau. So if you want the truth, here it is. Rewards only matter after the fundamentals are clean. If you pay in full, on time, every month, and you were going to spend that money anyway, rewards can be a bonus. But if the rewards cause you to spend more, rationalize purchases, or keep a balance, then the rewards are bait, not benefit. Now this is where it gets interesting. The third thing credit card companies don't want you to notice is that interest is not just about the APR. It's also about how your payment behavior changes the rules. Most people think APR is the only number that matters. It matters a lot, yes. But there's another layer. When interest starts applying, what transactions it applies to, and whether you still have a grace period. For example, a lot of people don't fully understand the grace period. If you pay your statement balance in full and on time, many cards let you avoid interest on new purchases. That's how disciplined users get convenience without paying finance charges. But once you start carrying a balance, things can change. Now your card may begin charging interest on new purchases in a way you weren't expecting, unless and until you fully pay off the balance and restore that grace period under the card's terms. Consumer Financial Protection Bureau. In plain English, here's what happens. You thought, I'll just carry this one balance for a little while. But now every new swipe can become more expensive than you realized. That morning coffee, that gas fill-up, that Target run, that last-minute Amazon order, not because the item changed, because your payment behavior changed. And this is why people feel like they're making progress while still going nowhere. They're paying, they're swiping less, they're trying. But because interest is working under the hood differently than they understand, the debt sticks around longer than expected. This is why this matters. Credit card debt is rarely just a math problem. It becomes a systems problem. You have to understand the rules of the product, not just the balance on the screen. Now let's go one level deeper. The fourth thing they don't want you to notice is that 0% interest and no interest are not always the same thing. And this is where a lot of smart people get caught. You see a promotion for a big purchase: furniture, dental work, electronics, medical bills, home improvement. The pitch sounds simple: no interest for 12 months. What most people hear is, great, I've got a year, and this costs me nothing. But sometimes that offer is not a true 0% APR offer. Sometimes it's deferred interest. Huge difference. With true 0% APR, if you still have a balance left when the promo ends, you generally start paying interest going forward on the remaining balance. With deferred interest, if you fail to pay off the full promotional balance by the deadline, you can get hit with interest retroactively on the original purchase amount from day one, depending on the terms. The CFPB has repeatedly warned consumers about this exact distinction. Consumer Financial Protection Bureau. Now think about how dangerous that is. You could be making payments the whole time. You could feel responsible the whole time. You could miss the finish line by a tiny amount, and then boom, a chunk of interest shows up because the deal was never what you thought it was. That is not a small technicality. That is a completely different financial outcome. So if you ever hear no interest if paid in full, focus on the word if. That one word can cost you a lot of money. And now we get to the fifth thing, which might be the biggest one of all. Credit card companies don't want you to notice that the product works best for them when it becomes part of your identity. What do I mean by that? I mean when you stop thinking of a card as a tool and start thinking of it as part of your lifestyle. I'm a travel hacker. I'm optimizing points. I only use premium cards. I put everything on the card. I'm getting perks. Maybe, maybe not. Because a lot of people are not actually optimizing. They are just normalizing debt, normalizing overspending, and normalizing living one billing cycle ahead of their actual cash. And that's a dangerous place to live. Because when your income gets tight, when inflation stays stubborn, when an emergency hits, when hours get cut, when life happens, the card stops being a convenience and starts becoming a pressure valve. That's how people slide into debt without ever having one dramatic moment. Not with one crazy decision, with 1,000 ordinary ones. And the bigger issue underneath all of this is not really credit cards, it's control. That's the deeper goal. This is not just about avoiding interest. It's not just about your credit score. It's not just about whether you get airline miles. It's about whether your money is organized around your goals or around your monthly payments. Because when your financial life is built around debt maintenance, you don't have freedom, you have motion. Those are not the same thing. A lot of people think financial stress comes from not making enough money. Sometimes that's true. But a lot of financial stress also comes from not seeing the hidden drains clearly enough to shut them down. And credit cards are one of the easiest places for those drains to hide. So what do? You stop being impressed by the marketing and start becoming obsessed with the mechanics. That's how you win. You don't ask, what perks does this card have? You ask, what is the APR? What happens if I carry a balance? Is there an annual fee? How does the grace period work? Is this true 0% APR or deferred interest? Am I spending more because of this card? Would I still make this purchase if I had to use cash today? Those are the questions that protect you, because credit card companies make money from confusion, convenience, and human optimism. I'll pay it off soon. I'll be more disciplined next month. This bonus makes it worth it. It's only a small balance. That thinking is expensive. And look, I'm not telling you to cut up every credit card and live like it's 1985. I'm telling you to stop being casual with a product that punishes casual behavior. Used correctly, a credit card can help with convenience, fraud protection, and credit building. Used incorrectly, it becomes one of the fastest ways to leak money without realizing how bad it is until months or years have passed. That's the truth. So here's what I want you to do after this video. First, pull up every credit card you have and look at the basics, not the rewards page, not the branding. Look at the actual terms. Check the APR. Check the annual fee. Check whether you've been carrying a balance. Check how much interest you paid last month. Check whether any promotional offer is true 0% APR or deferred interest. Second, if you are carrying a balance, stop thinking in minimum payments. Start thinking in payoff strategy. Pick one card. Cut unnecessary spending for a season. Attack the balance aggressively. Because the goal is not to stay current forever, the goal is to get free. Third, if you use rewards cards, create one hard rule. If the balance is not paid in full every month, the rewards no longer matter. That rule alone will save a lot of people. Fourth, separate spending from self-deception. Before you swipe, ask yourself, would I still buy this if there were no points attached? Would I still buy this if the money left my checking account today? If the answer changes, the card is influencing your behavior more than you think. And fifth, remember what winning actually looks like. Winning with credit cards is not having the fanciest card. It is not collecting the most points. It is not feeling sophisticated because you know travel transfer partners. Winning is simple. You use the card. You get the convenience. You pay in full. You avoid fees. You avoid interest. You stay in control. That's it. Simple beats flashy every time. If this changed the way you think about credit cards, do two things. First, share this with somebody who says, I'm fine, I just make the minimum. Because that mindset is exactly how people stay stuck for years. And second, subscribe if you want more breakdowns like this. Plain English money content that shows you where the system gets expensive and how to stay ahead of it.